Hey, Shelley, can you take roll? We're going to get started.
Chair Josh McGee,
Here.
Robert May,
Here.
Andrew Cable,
Here.
Robert Massengale,
Here.
Stephanie Leiby, Keith Brainerd,
Here.
Ernest Richards.
Here. This is the May 5th, 2016 meeting of the Texas State Pension Review Board, and a quorum is present, so we're going to get started here. So the first item on our agenda is to discuss and consider the board administrative matters, including the adoption of the minutes. So I need a motion to suspend the reading of the minutes.
So moved. Second.
So motion was made and seconded to suspend the reading of the minutes. Is there any discussion from the board or any corrections of the minutes that were circulated? Hearing none, we will suspend the reading of the minutes and take a vote on that. All in favor say aye.
Aye.
All opposed? The ayes have it. Minutes will not be read. The minutes are approved as circulated. The next item is excusing the absence of board members from our previous PRB board meeting on February 11th, 2016. The chair entertains a motion to excuse Mr. Robert Massengale from the February 11th, 2016 board meeting.
So moved. Second. He was watching us.
You were watching us. Did we do a good job? You approve?
You did a good job.
Thank you. Motion has been made and seconded to excuse Mr. Massengale from the February 11th, 2016 board meeting. Is there any board discussion on this item? The motion is to excuse Mr. Massengale from our previous board meeting. All in favor say aye.
Aye.
All opposed? The ayes have it. Mr. Massengale is excused from our February 11th board meeting. Judge Cable, the next item on our agenda is yours.
All right, thank you very much. I'll call in Christina and Michelle, please help me out with this.
Good morning. I'm giving a quick update on the MET program, and we're going to first update the online training. We currently have 2 courses available: Risk Management, which we are pleased to announce became available this week, and Benefits Administration. Staff is currently working diligently to have the rest up by fall 2016. We'll be uploading the courses as they are finished at a regular interval. Number 2, we're going to talk about the forms. On March 1st, 2016, we had our first reporting period for the MET program. We have been communicating with systems who have not turned in their reports and are providing assistance to help them get them in. Staff is also working to process all PRB 150 forms, which contain trustee and system administrator term information. We will begin reaching out to any systems for which we have questions. After the PRB 150s have been entered and processed, we will begin to process the PRB 2000s, which contain the actual training information completed for each trustee and system administrator. This will likely begin in June. To date, we have processed 9 previous training forms and have communicated the results to those previous training forms and have communicated the results to the systems, and we are currently in the process of reviewing an additional 10 forms.
And I'm Michelle Cranes. Good morning, Deputy Director with the agency. On item C, discuss and consider the final adoption of proposed rule amendments relating to the minimum educational training program. We published the proposed amendments in the Texas Register on March 18th for public comment. We did not receive any public comment, so we are now requesting the board adopt the amendments and approve the final notice to be published in the Texas Register. Happy to answer any questions you have.
Mr. Chairman,
Yes.
you indicated that the risk management component is now available. Is that online
It is.
on the
PLD website?
Yes.
Thank you.
Any other comments from the board on this item? The chair entertains a motion to adopt the rules as presented in Texas Administrative Code Title 40, Part 17, Chapter 607, relating to the Public Retirement System Minimum Education Training Program and authorization, and authorize the staff to post the rule adoption notice in the Texas Register with a preamble to approve, to be approved by the Assistant Attorney General Counsel. Need a motion?
Second.
Motion has been moved and seconded to adopt the rules as presented in Texas Administrative Code Title 40, Part 17, Chapter 607, relating to public retirement systems, minimum education training program, and authorize the staff to post the rule adoption notice in the Texas Register with the preamble to be approved by the Assistant Attorney General Counsel. Is there any discussion from the board on this item? Hearing none, I'll read the motion once again and we'll take a vote. So the motion is to adopt the rules as presented in the Texas Administrative Code, Title 40, Part 17, Chapter 607, relating to the Public Retirement System Minimum Education Training Program, and authorize the staff to post the rule adoption notice in the Texas Register with the preamble to be approved by the Assistant Attorney General Counsel. All in favor say aye.
Aye.
All opposed? The ayes have it. There being no further discussion, thank you, Judge Cable.
Thank you, Michelle, very much.
Thank you.
Good
Yes,
morning,
ma'am.
Mr. Chairman and members. To quickly circle back on the risk management course, staff would like to thank Mr. Brainerd and Erin Perales of Houston Municipal Retirement System to provide feedback on the course and make it even better. Thank you.
Yeah, thank you very much for that feedback. I'm sure it improved the course greatly. All right, moving on here to number 5 on our agenda. That is in tab 3 of your materials. We're going to receive a presentation from the Dallas Police and Fire System. We asked them to come after the discussion at our last board meeting, and Ms. Kelly Gottschalk is going to give a brief presentation to us today. Kelly?
Thank you, Mr. Chair and members of the committee. I appreciate the opportunity to be here today.
Sorry, I forgot to mention, you should also note that her presentation is provided in the back of your packet.
I appreciate the opportunity to be here today. Our system and what's going on right now is very complicated, and it's hard to really understand it from the numbers. And I know your staff has provided a really great report for you, and what I hope to do in this presentation is not repeat everything that's in the report, but try to give you some color to understand what's going on. With me today, I have the chair of our board, Sam Fryer, and also our general counsel, so if you have tough questions, they're here to help. I don't know if you've got the presentation so the members of the audience can see it?
It is not loaded, but we've got it here in front of us. It was included
Okay.
in every member's packet.
Okay, great, thank you. All right, I will go through this. What I want to do is just, the outline is start with a very brief overview of the system, talk about our challenges and where we are today, give you a little background on some of the challenges, talk about what we've done so far as the plan, and as far as plan amendments go, and then go into what we're doing now to solve our current issues. So as you are all very aware, we're a single employer defined benefit plan that provides disability, retirement, and death benefits for Dallas police and fire officers. We have a 12-member board. There's 4 city council members on the board, and there's 8 service trustees. 2 of those are retired, former one from the police department, 1 from the fire department, and 6 are active, 3 from each of the departments. We have actually 2 plans. So we have our big plan, which we'll call the combined plan, and most everything I'm going to talk about today relates to that plan. We have a supplemental plan, and that's just for those basically chiefs above the civil service rank. It's kind of an add-on to take into consideration their whole salary for their benefit. It's such a minor part, I'm not going to really talk about that today, but if you have questions, I'm happy to address those. Our plan was established 100 years ago by ordinance. It's been in the state statutes since 1933. The plan can be amended by a 65% vote of the members and also by the legislature, of course. Currently, the contribution rates are flat and they're set by statute. The city's paying 27.5% currently, and the members pay 8.5%. The statute allows the members to go up to 9% and the city to go up to 28.5%. So we're a little bit from the top. Our members do not participate in Social Security, and we do have a drop program. So that's just a brief overview. The next piece I want to talk about is kind of my disclaimer. Based on the timing of where we are in our audit cycle and our actuarial valuation cycle, a lot of the information that I'm going to give you today related to 2015 numbers are estimates. We think they're pretty good estimates, but don't be surprised if they change a little bit as we go through. Because of our assets, it takes quite a long time to get reporting from third-party managers, so we're working through that. And we also changed our actuary this year, so that's a little bit of a delay as well. But currently, our estimate is our 12/31/2015 asset balance will be $2.7 billion. And we just completed an experience study with our new actuarial firm, and based on the analysis and the assumptions that were adopted by the board in April, the estimate that our funding level will be 46% moving forward. I'll talk more about that in a little bit. And one of the things that's important to understand is the issues that we're facing today didn't come about today or last year or the year before that. This is really a decade or so of decisions that were made a long time ago that are now working their way through the system, and because of the changes that we're making, we have a better view of what those issues are. So it's not that we just became a lot less funded. We just now really know where we are, and that's where we're headed. So going into the next section, I talk a little bit about the challenges. And I don't want to delay on the past because I can't really do anything from the past but learn from it. But because moving forward in solving the plan, it's going to be very complicated. Part of the reason it's very complicated is because it's complicated why we are where we are. So I have a lot of bullets on this page, and I don't intend to read them all, but I wanted just to really highlight for you what's our problem. Unfortunately, it's not a simple problem. So to go through this pretty quickly is, we're a mature plan. We've been around for 100 years. We have fewer active members every year paying for more and more retirees. Our payroll growth has been less than expected due to reduced hiring at the City of Dallas and lower raises. We have fixed contribution rates from both the city and the employees, so they don't float up as our funding needs might demand. We also are in a position that we have significant net cash outflows. Currently, I think in your report it was over 4%. This year we're estimating 6%, and it'll probably go up to 8%. We're actively, in addition to the contribution and distribution mismatch, we're actually actively paying down debt, which is part of that cash outflow this year. Our drop provisions have contributed to increased accrued liabilities, resulted in a material loss to the fund, and have created a big liquidity challenge. Previous actuarial smoothing, overstated real estate asset values, and high rates of return assumptions actually masked the actual funding level of the plan, which caused a delay in taking the necessary actions to solve the plan's issues. We have done plan amendment changes, 3 of them, which I will talk about, that reduced benefits. Unfortunately, they were based on flawed information. We've had significant write-downs in our assets between the years 2013 and 2015. And basically, I'll show you some numbers later, we've really lost an entire decade of investment returns. We have lower expected future capital market assumptions. So, investment returns of the future are not going to solve our problem, unfortunately. And what we know based on our portfolios is going to take time to fix this. So that's kind of the summary, big picture of our problems. It's a long list, unfortunately. So, but just to go to the next slide, I have on this chart, it's actually kind of one of my favorite charts, but it's basically distributions versus contributions. And the bars on the left show total distributions of the plan starting 11 years ago. And you can see that it ramps up pretty significantly. So in that time, we go up 154% in total distributions. The set of chart bars on the right side show contributions, which are pretty flat. They've only gone up 35% in the same 11-year period. The bars in the middle are basically distributions without drop. And I prepared this originally because people are saying, well, drop's the big problem, it's the only problem. Well, it's not the only problem. So you can see, even if we didn't have drop, our distributions are exceeding our contributions. Normally, you would want your investment returns to make up for that, but as you'll see, ours haven't done that. This next page, page number 8, is a chart that we provide to the board at every board meeting, and it shows our drop balance as a percentage of total assets. The blue bars are our total assets, which ending in 2015 was roughly the $2.7 billion, and the red bars are the drop balance. At the end of 2015 was $1.5 billion. In October of 2015, it was the first time the drop assets exceeded 50% of the fund. And you can see now they're about 56%, probably almost 60%. That's a combination of the drop assets are increasing and we're writing our market value down. So this creates a large liquidity problem for us. 1/3 of the assets are in people that are continuing to work but have entered drop. 2/3 of the assets are people who have retired and left the system. And they can take their money out every week if they
Mr.
like.
Chairman,
Yes, Mr. Bernard?
excuse me, I'm not sure everybody here would understand what a drop is. Would you mind backing up and just explaining what a drop is?
Sure. A drop, we started a drop program in 1992, and what that does is a member can decide if, when they're eligible to retire, if they want to freeze their benefit at that time and continue to work, and the benefits that they would have received, their retirement payments that they would have received had they gone ahead and retired, are put into an account for them. They don't have access to those dollars until they actually retire and leave the system, and then they can access those. Our drop is a little bit unusual because we don't limit the time somebody can be in drop. So some people have been in drop a very long time. Other systems may limit it to 5 years or something like that. The other part about our system that's a little bit unusual is some systems require that you take your money with you when you retire. We allow people to leave their money in. So that's what happens.
Thank you. Can you address the issue of legal rulings with regard to your drop? Have there been any legal rulings regarding your drop plan?
We are in the process. We did a plan amendment in 2014, and we have been, that plan amendment is under litigation. What we had done, the plan amendment changed the interest rate credited to drop, and that is going through the legal process. It's on appeal at this point.
From what to what?
Currently, prior to the change, the interest rate credited to drop was between 8 and 10%. And the change in the plan amendment basically tried to stair-step that down. So every October, it went from 8%, and then this October 2015, it stair-stepped down to 7%, and then it will go to 6%, and then it will go to 5% after that. And then if certain triggers in the plan happen, which they would be triggered now, then the interest rate credited to drop go to 0.
So do I understand correctly that there may be people who are retired and receiving a pension benefit who also have drop assets with your plan, and those drop assets are accumulating at 8% annually?
Sir, they were accumulating. Everything you said is correct, except for last October we lowered the 8 to 7. So right now they're accumulating 7% annually.
Even for people who have retired and are receiving a pension benefit?
Yes, sir.
And can you repeat the issue of the status of the litigation regarding that plan?
Josh, would you like to?
Yeah. So back in at the end of 2014, some plaintiffs brought a case to challenge the constitutionality of the plan changes, and the district court initially ruled in their favor, and then reversed. The judge reversed herself and ruled in our favor. So basically, the judge held that these prospective changes to the interest rate were constitutional, and now it's on appeal to the Fifth Court of Appeals.
So the basis of the litigation was with regard to the reduction in the interest rate?
Correct.
And right now, the courts have ruled in favor of the system or the city to make that change?
Correct.
And what level of court is that at right now?
The Fifth Court of Appeals in Dallas.
Thank you.
Another question on this issue, is the interest rate change built into your liability calculation, or is this something that you realize over time depending on the difference between realized returns and the interest credit?
The actuary has taken into consideration that stair step down to 5%, but then moving forward, they've left that at 5% because if they would have actually let that drop to 0, it may have overstated the assets.
So this is built into the liability number that we are, the change, the reduction is built into the liability number that we are seeing?
Yes.
Okay. And if there were a court to rule against that change, the liability number would go up?
Correct.
Okay. Another thing that I was very interested in, do you know the average duration in drop participation?
We do. It's approximately 8 to 9 years that people work while they're in active drop before they actually retire.
And then do people usually leave their money in the plan and participate in retirement?
Absolutely.
So 2/3 of this, this 56% is with people who are retired, and the majority of people who enter drop, who reach retirement age eligibility, remain in the plan once they leave employment with the city.
Yes, sir.
Do you have concerns? So talk a little bit more. I would like to dig into this liquidity issue. So this, you rightly say that this is a big proportion of the assets of the plan. How are these assets? Are these assets invested any differently than total plan assets? What exactly is the liquidity issue other than the fact that you may have a call on assets at any time?
So the assets are invested just as other assets in the plan. They're not a separate account. We know the number, we know everybody's drop balance, but they're commingled with all of the total balance. The issue is exactly as you indicated. The way our current operation is you can ask for your money on Tuesday and you get it on Friday, and there aren't restrictions. So that's a challenge. Right now it's not an issue because it's hard to beat a 7% return anywhere in the market today.
Are you concerned that the cash out percentage will increase as we step down this interest credit rate in the plan?
I believe if we let it drop, if we let the triggers happen and it goes to 0, I would have great concerns. But that is one of the issues that we are addressing in our next plan amendment change. We will change the way that works.
Are you planning for this on the asset side so that you will have enough cash on hand to handle those outflows?
We look at that every day, and so our new asset allocation has been designed specifically to generate cash and to improve liquidity.
And what do you expect the implications for your investment rate of return to be over the next 5 or 10 years of that change in asset allocation?
So the board just adopted a new asset allocation in March, and based on our investment consultant, NEPC, the numbers they have without alpha are 7.7%. But we do know that it's going to take time to transition into our asset allocation, and we're running our projections based on those numbers at this time.
Did your investment consultant provide you any probabilities of achieving that investment rate of return over, say, a 5, 10, or 15-year time period?
They provide a 5 to 7 year forecast and a 30-year forecast, and they have looked at the standard deviation and the chances of achieving that.
To be clear, the rate that they provided in that forecast is the median, so there's a 50-50 shot that the plan, they expect there to be a 50-50 shot that the asset allocation as laid out by the plan will achieve that rate of return?
I'm sorry, I can't answer if what they give the probability, but they believe that based on the asset classifications and the standard deviation and the capital market expected returns that they're looking at this point, they believe that this rate of return is achievable.
Have you run any downside scenarios and looked at the effect on both liquidity and go-forward asset cost?
We are running a lot of different scenarios based on, frankly, a lot of it has to do with time to transition our assets because we have a lot of real estate and a lot of private equity, and we're looking at different scenarios related to those. And we've done internally quite a bit of modeling to take a look at that.
Great. So I, for one, am very interested to kind of understand over time how this liquidity issue will affect the plan. And the board, I'm sure, would like to be kind of kept abreast of that liquidity issue. I'm also very interested to better understand kind of expectation for investment returns over time, and also to prepare both the plan members and the plan sponsor for the potential that the expectation is not realized, and that we have to adjust over the next 5 to 10 year period to make sure that enough money is coming into the plan to cover promised benefits.
Okay.
One additional thing on this drop program is substantial relative to the plan. How does COLA play into this drop program? It is my understanding that the plan has a 4% simple annual automatic COLA. Do members, once they enter the drop program, does their annuity increase with that COLA annually?
The way that the COLA works is if you were hired prior to 12/31/2006, you receive the automatic simple 4% COLA on your original benefit. So if your benefit's $1,000, you get 4%, you get $40. That will be your annual adjustment every year. 20 years from now, you'll get another $40 if it's still in place. Members hired after 2006 and between 2006 and the end of February and 11, they have an ad hoc COLA, so that's not a guarantee. Members after that don't have a COLA. So we've got that pool of members that do receive it. They receive it as soon as they enter into drop or retire.
Mr. Chairman, has there been an effort made to modify the 4% COLA?
At this point, no, there has not, but that's one of the things that we're looking at.
You're saying that the board is considering making an effort to reduce the 4% COLA?
The board is looking at all of the plan features, including the COLA.
But so far, at least in recent history, the only legal ruling that y'all have experienced is the one that you described with regard to the drop?
The legal ruling, yes.
Thank you.
I assume you're still on page 8, is that correct?
Pardon me?
We're still on page 8 of your presentation, is that correct?
Actually, we could go to 9 if there's...
Well, no, I have a question. No, I have a question on 8. I just want to make sure
Okay.
when it's on page. There are a lot of numbers on page 8, and there's a lot of color charts and a lot of information. Can you take a second and explain what page 8 is all about?
Is this the page you're referring to?
Right,
Okay.
page 8.
So this is basically to try to we do this for our board each month, and we
Right.
let them know how much of our total assets are in drop accounts, and that's important because of the liquidity feature, but also for planning as we move forward.
Thank you.
Mr. May?
Yeah, just, could you refresh my memory on, from a legal standpoint, how you operate? A number of plans in Texas legally operate under changes in their plan that are developed as changes in Austin at the state level. Others have authority at a local level, and I think you're in the latter category of any of these changes in drop or level of
Excuse me, thank you.
decisions are all under local law. Is it city ordinance?
Mr. May, for the regular plan, not the supplemental plan, to amend the provisions of the plan requires a 65% vote of the active members, or the legislature can do it.
Or the state legislature?
Correct.
Or 65%.
Mhm.
So for clarity, you have a statute that is specific for this plan in Vernon statutes, and it also provides the authority to amend the plan locally with a vote of fully 65% of members. That is memorialized in a document that is...
It's in our plan document.
Gotcha. Okay.
And is that how the drop was designed as well? The vote of the members?
Absolutely.
Was there consent of the city council?
It doesn't require consent.
There are 4 city council members on the board.
Is there a requirement that the city council be notified when plan changes are made, or does it just take a vote of the members, and who proposes and runs the vote of the members?
I don't believe there's a notice requirement. There are, as Mr. Fryer mentioned, 1/3 of the board are city council members, appointed by the mayor, approved by the rest of the council. The election itself, we have a policy that lays out how we do elections with all the notifications and that type of thing. We have an outside firm that handles the election for us, and we're not involved at all. They communicate with the people and give them their PIN numbers and do all that and provide the report, the results to us.
But the board has to first put it on the agenda for the members. The board has to vote the plan amendment, and then the members vote on it.
I see, thank you. Please proceed.
Okay. On page 9, page 9 is just a line chart that shows the market value of the plan versus the actuarial value of the funding level of the plan. And one of the reasons I think that this is such a surprise to our members that we're all of a sudden in this position is we've focused, as a lot of plans do, really on the blue line here, the actuarial level of the plan. However, you can see the market value is significantly lower than that. So, and in 2012, what the board had done is they moved the 5-year smoothing that was in place to a 10-year smoothing. Therefore, they deferred a lot of the losses that would have been realized and kept that number up there. So, in a sense, the members had false information that they were working off at that time. You can see on this chart, this hasn't been updated for our 2015 numbers, but I'd like to explain it to you because when you see this, might be a little surprising. What the board did with the experience study that they adopted last week is they changed the smoothing method.
You're on page 10 now.
I'm sorry, I'm still on 9, or 10, I'm sorry. Well, let's see.
You're right. It's not.
9, thank you. So one of the changes the board made last month was to go from a 10-year to a 5-year smoothing. But what we decided to do is because of a lot of our losses at this point aren't related to market fluctuations, they're related to we had bad asset values, really. So the board decided to basically true up those two numbers. So when you see the report, the valuation report this year, you're going to have the same number for the value, and it's not going to be a nice number, probably around 46% for both the market and the actuarial funding percentage. And then from there, we'll start the 5-year smoothing. We just need to clear all that out and start over. So.
Did I understand you correctly when you said that you believe that 10-year smoothing provides false information?
I believe in this situation, we ended up reporting a number that made us look better than we actually were. I mean, I like to work off of the market value because I need to work off of numbers that I know that I have. The smoothing, in my mind, is helpful when you have a plan where you have a fluctuating employer contribution or employee contribution. I don't particularly see the value with smoothing if you're not having huge budget implications. So I personally don't understand the 10-year smoothing, but that's gone now.
I 100% agree with you.
Well, just a quick comment. These smoothings 5 or 10 years out are something that actuaries look at because over a long period of time they stabilize contribution rates.
Mm-hmm.
Right.
In your case, you don't have contribution rates to stabilize.
Right.
But that's where they come from.
Is the employer rate still fixed
Yes, it is.
at what percent?
27.5.
What does it take to, so a couple of extensions of this, what does it take to change the employer rate? And is the employer rate, my understanding from your earlier comment was the employer rate is currently has an overall cap of 28%, and it cannot go beyond it, and I would like to understand the nature of that. So what does it take to increase it up to that cap, and what does it take to change that cap?
So we believe that if we increase the employee contribution from the 8.5% to 9%, we believe that the employer's percentage goes up automatically. There's a table in the law that is laid out. If we're 9%, they're 28.5%.
In state law?
In state law. So we believe that that's how that works. And I don't know if the city believes that or not, so that's why I said we. But we plan on, in our plan amendment changes, to ask for contribution increase. We can go up to the 9%. We also think that to go above the 9%, we're going to need to go to the legislature.
Am I correct in reading in the information that the PRB staff put together that the 30-year recommended contribution in 2015 was 42% of payroll?
That's
from
correct.
the employer? And I believe I'm looking at a number here that says that the January 1, 2016 estimated number is 65-66% of payroll.
Correct.
So the employer contribution as estimated and shown in these numbers would need to double or go towards tripling to meet the needs of the plan?
That's true unless we do plan design changes, and that would potentially lower that number.
Thank you.
Thank you. The next slide, slide 10, just shows our rate of return compared to the assumed rate of return. I may have mentioned we had an 8.5% rate of return until July of 2015. We then moved that down in one fell swoop to 7.25, again with the idea of doesn't do me any good to put a number out there that I don't believe in. So let's fix it. Let's not do a stair step. Let's put the number where we think it needs to be. So we moved that down to 7.25. I can tell you the actuaries have looked really hard at that number, and they haven't recommended a change in it. You can see that over time, and most recently, we haven't exceeded the 8.5%. And one of the things I wanted to point out is these are the returns that we reported. And what we know now is probably from 2004 until the last few years, they were probably overstated.
Sorry, they were overstated because we did not have accurate values for portions of the portfolio?
Yes, sir. The next two slides are an attempt, and I'm not sure if I add confusion or help it, to try to understand some of these timing issues and how they impact the numbers. And I know in the report that the staff provided to you, they show our investment returns. And these numbers on this slide 11 are provided by our investment consultant, NEPC. And we report our private assets on a one-quarter lag. So it's really hard, I think, to understand when you see the 2014 numbers, which were in your report and are here in the blue line, why, with these results, all of a sudden did we go from 26 years to fund to infinite, and we're showing this dire situation. And it's that lag in the investment results that you're not seeing. So I provided for you the 2015, which includes the fourth quarter of 14 write-downs of real estate, as well as all the write-downs in 2015. So you can see it's quite a different story in 2015. So our one-year return is a minus 12.6%, 3-year minus 7%, 5-year 1%, and over a 10-year period we've only earned 2.7%, which was why I said basically we've lost a decade of investment returns. Our largest losses or write-downs in the 1 year are in real estate, which was written down 31%, and private equity 20%.
Tell me again what percent of total assets would be real estate and private equity?
Real estate's approximately 25%, and private equity is, let me grab that number.
That's the latest figure that after the write-downs, it's 25%?
Yes.
What was it at its peak?
As a percentage, I'm not sure of that number. Do you know?
It was probably somewhere between 30 and 33%, I think.
And the private equity portfolio?
Private equity currently is 13.7%.
Do you believe you're finished writing down the value of the real estate and private equity?
So I can tell you right now the assets are valued at the best, based on the best information that we have. But what I'll also tell you is that information changes every day. And based on some of the investments in our portfolio, a lot of them are vacant land, and everybody's got an opinion on what you can develop there, and then another opinion on what it will cost to develop that there. And those things can swing wildly from appraiser to appraiser. So at this point, I hope the assets are close to where they need to be, but I can tell you our procedures are in place to do everything we can to have the best number.
I'm very interested in, so clearly there were some problems with the investment portfolio and some decisions that were made and the information that was provided. This is great information. I'm very interested to know, though, from the plan level, from the board level, what changes have been made around the investment function, decision-making, reporting to rectify this issue.
So let me skip forward to, if you don't mind. slide 21 talks a little bit about our investment. So I can tell you, structurally, things are very different. I've been with the system for a year, and prior to me, there was an administrator, and that administrator handled operations as well as investments. When the board hired me, they changed the position to an executive director with a chief investment officer, and the chief investment officer reports to me, which provides checks and balances. So that's one big change. So we've hired a chief investment officer, changed the organizational structure. We've done an asset liability study. We've got a new investment policy in place. And with the investment policy, the old policy was frankly written to provide the most flexibility to the staff to do investments, to take advantage of opportunities. We have a lot of checks and balances in our investment policy now. We have defined roles and responsibilities. Nothing gets on the agenda through the the CIO that I don't agree with. It just doesn't happen. So, but we've also put in place, number one, the policy lays out roles and responsibilities of the board, of the staff, of the consultants, and of asset managers. So that's all in place. The other thing is we've just adopted, when we did the new investment policy last month, a change to our investment advisory committee. Before it was made up of members of the board only. And now it will be a 7-member committee, 3 members of the board, 1 council person, 1 police, 1 fire, and then there'll be 4 outside investment professionals that don't have conflicts with the system. And all investments will have to, first of all, go through our staff, and they'll present, to me, and we'll have to have our consultant give a written opinion on what they think about the investment, goes to the investment advisory committee before it can go to the board. So we can't leapfrog any of those steps, which I think will provide some assistance. We also, in the investment policy, require not only a written opinion from the investment consultant on buying into new investments, but also they give us concurrence on rebalancing to make sure our rebalancing decisions make sense. So we've done a lot related to that. We've improved our investment reporting as well. It's a lot clearer now to the board on what's working, what isn't working. What else have we done? Changed the asset allocation, new policy, those types of things.
I'm also very interested in how, you said that you reduced the discount rate, the assumed rate of return on assets. You should be applauded for that. That was a necessary step, and I know it was not an easy step. But I would be interested to know how that rate is set and how it will be set in the future. Of course, my opinion is that the board, members, and city council needs to understand the potential, the probability for downside scenarios. So they need to understand kind of what the believed probability, the expectation is that the plan will achieve that rate of return over different time frames, and they need to understand the implications of not realizing that rate of return. So not doomsday scenarios, but what happens if we miss by 100 basis points? What happens if we miss by 200 basis points? So I'd like to know the process. I'm concerned that it sounds a little circular in that it's consultant driven. It can get pretty consultant driven, so the investment consultants make recommendations, the actuaries take those recommendations without fully questioning them. I'm a little worried that it gets a little circular and doesn't really consider the probability that that's going to be low enough.
I understand that completely, and it's a difficult number to set. So I'll tell you how we ended up here. So when I started a year ago, and we were in the middle of the audit, we had a brand new audit firm because we terminated our old audit firm. The new audit firm has a consulting actuary that works for them. I received information from our former system actuary, and it said 8.5 is reasonable. And I'm thinking, well, it seems high to me, but okay. So I'm thinking, okay, I want to do a whole experience study, which was the plan. We'll do everything at once because I don't like just changing one assumption. But we were faced with this issue of The auditors were not comfortable with the 8.5% because their actuary, which isn't affiliated at all with us, was not comfortable with the 8.5%. We had many conversations between their actuary and our actuary, and I became less and less comfortable with the 8.5% as those conversations were going on. I'm a CPA. I do not sign off on financial statements that I don't believe are accurate, which is another reason I went all the way down, because I couldn't justify doing a stair step and have fairly presented financial statements. But I literally ended up in this position of dueling actuaries between the two. So I called a third actuary in, and I said, I need for you to help me figure out how to set this rate of return. So this person, not affiliated with our system, did a study and came up with okay, here's a reasonable range based on where you are with your current portfolio. And we took that to the board and talked about that. When we hired the new actuary firm, they've dug really deep into that, because we know it's going to be a challenge in the next few years to get to the 7.25 with our portfolio. We understand that. And they tested that, and we provided information on timing to transition and those kinds of things. And they challenged it, and they've come back to the board last month and said, okay, we think this is okay. And they've worked with their actuaries as well.
7.25%.
The 7.25.
Have you looked at scenarios? I agree that it's going to be challenging over the next 5 to 10 year period, especially given the difficulties with your portfolio in particular, to achieve that investment rate of return. Have you looked at scenarios where you miss by, let's say, 100 or 200 basis points, and looked at what happened, what that does to your assets and liabilities, the spread between those two, as well as to the ARC, so the cost to the employer?
In October, we had a workshop with the board where we talked about, we had NEPC present the asset liability study, but I took that and I took it one step further because I knew we were doing a new asset allocation, and I wanted to know for myself, given our situation, what's worse for us, sustaining a big loss or missing our rate of return? So do you take more risk to try to get there, and because of our current situation, what hurts the most? And I presented, 30 different scenarios of if you miss it by 1%, if people take this out in their drop, if you earn this, or you have a big loss, early, late. And the board looked at that and considered that in adopting their asset allocation. So we have looked at it. I didn't go as far as looking at the ARC, because in our situation right now, I'm concerned about having the check to pay the benefit when it's due. I'm not as concerned about, years to fund or any of that. That's all measuring. And if I can get there and I can make those look great, we'll all sleep better at night. But right now, I'm just trying to make sure I have the money when I need it. So I wasn't looking at how it's going to impact the accounting entries or anything like that.
Go ahead.
Okay, where were we? Okay, so back on 11, this was just basically to show you the timing difference in the investment returns. And then what I tried to do on 12 is to take 12 to say, all right, what's going to happen now? Because some of those investment losses that didn't impact the investment return in 14 but did in 15 were already considered in the financial statements and the valuation report. So that's what the attempt on this page 12 is to say, kind of how those numbers flow. So you can see in 2014, our investment performance reported our net assets at $3.3 billion, where in the evaluation, the actuarial valuation and the financial statements, it was approximately $3.1 billion. So that was a $200 million difference there. In 2015, again, these are preliminary, our investment reporting's $2,776,000, and right now the valuation and financial statements look like $2,727,000, about $50 million difference. So from year to year on the assets actually go down $568 million, but the valuation report, the actuarial valuation of financial statements, has already taken about $200 million of that into consideration. So you don't have kind of the even, they both go this way, but not the same rate. So that was an attempt to try to explain those numbers. On page 13, this was kind of another attempt, and this comes out of conversations really with members when they're saying, how did we get here? What happened? Is it all default of mismanagement of the assets? Is it all the droppers? What is it? So what we did is we had NEPC prepare for us an analysis of if you started in 1/1 of 2005, which at that point we believe that our asset value was a good number because that was before we started to get into all the real estate. So we have confidence in that number. And you inflated that number and you earned what a median plan earns, an average plan in their universe. How much money would you have? If we were just average, how much money would we have? And you compare that to the last, that's the line going across the top. If you compare that to our green bar, what we actually have, you can see that part of our problem, $1.1 billion of our problem, relates to bad investment decisions. That's what this chart's intended to show. The next page, 14, is the same exact chart, but I've added the accrued actuarial liabilities. That's the red line going across. And you can see, that, okay, the $1.1 billion of our problem relates to investment decisions, but there's another $2 billion related to plan design. And that I think is helpful when everybody starts pointing at everybody because it's lots of problems.
So your interpretation of the difference between the blue line and the red line is plan design?
It's plan design. I mean plan design to be very broad, meaning we have an old plan, it's a mature plan, so I have fewer actors paying to retirees. All of that coupled with the fixed contribution rates, coupled with the benefits and the drop provisions, that's what I mean plan design, kind of everything else.
So some of it is a shortfall in contributions.
Absolutely.
Yeah, and I would add in here that the blue line, while it represents the median plan return, also would have fallen short of your previous assumed rate of return. And so some of it is lack of reality in some of these assumptions, lack of those assumptions of meeting reality, I should say. So there's underperformance of the median plan, which is 1.1, and then you've got this bigger bucket up here that is some plan design features, contributions not keeping pace with liabilities, and missing assumptions.
You're correct.
Okay.
Page 15 is the analysis, one of the slides of the analysis that I was just talking about that we provided for the board in October. This will be updated once we get our final audited results, but it shows that if we don't earn the 7.25 for the next 5 years, but I had a minus 6.5, and then I assumed 5, 5, 5, and 5. That was just our best estimate in October. When do we actually cross zero? And that was 2030. This is information that the members have, the city has, that we're saying, okay, here's our window. This window probably lost a few years based on the things that we've done recently, but it's our reality.
What were the assumed contribution rates that went into this chart?
The 27.5% from the city and 8.5% for the. This is no plan design changes right here.
This is all current contribution rates.
Yes, as the plan is designed. If we do nothing, this is where we
So
are.
reading this chart, under current contribution rates, the plan would run out of money before 2030.
Well, we think that with the status quo, this is our estimate as in October. It will revise this, but with current contribution rates and no plan design changes. Okay, I mentioned a couple times we have done some plan amendment changes. In 2006, we went from the automatic COLA to the ad hoc simple COLA.
Excuse me, Mr. Chairman, I'm sorry, Ms. Gottschalk. When was the last time the board that approves the ad hoc COLAs?
The board does approve the ad hoc COLAs, but to do that, they have to have a letter from our actuary saying that it doesn't, I can't remember the exact words, but basically we can afford it. And you obviously couldn't get that letter this year, so we didn't do the ad hoc COLA. It was not October, so it would have been October of 14.
Is the letter required in your rules and state statute? What?
In our rules.
Did you want to say something, Mr. Chairman?
That was about 10 people, because since 2006, only the disability people are in that window.
Right.
So it wasn't very many people. But, yeah.
What do you mean only 10 people are in that window?
2006 is when the ad hoc COLA requirement kicked in. So since 2006, only about 10 to 12 people have retired.
People who are retired?
Yes.
I see.
So very, very small fraction of
I
people.
see.
Yeah.
Thank you.
That's a good point.
So the majority of plan members who are receiving a COLA are receiving COLA under the 4% simple.
Yes, sir.
Yes.
So in '06, it was the COLA change. In 2011, we did what a lot of plans do, is we did a new tier for new hires where we really changed the benefit structure, increased the multiplier, longer time to vest, longer period for average pay, extended retirement eligibility. We were less generous on both survivor benefits and disability benefits. That's not unusual. You kind of do that to people that aren't here yet. So we did that. We also, prior to that time, we didn't have the members that were in active drop didn't pay a contribution rate. We changed that for them to start paying an 8.5% contribution rate at that time. This, according to the actuarial report at that time, resulted in a $50 million gain to the system.
I'm sorry, the 8.5 contribution rate, that goes not to their drop accounts, but into the plan?
Yes. In 2014, because we wanted to, it became apparent that this high drop interest rate was creating problems for the system. The plan was again changed to enter that stair-stepping of the drop interest rate that we talked about, and the contribution rate for active drop members was reduced from 8.5% to 4% in an effort to get this plan amendment changed, I believe. And this was a change of a gain of $185 million to the plan. And one of the things that I think is important to understand is, at the time all of these changes were made, it was made based on the best interest that the best information that the board had and that the members had. They were done in good faith. They thought each time this was going to solve the problem, and they were just basing everything on flawed information, unfortunately.
I'm sorry, to be correct, the flawed information was related to just assets, or it was related to assets and the liability side?
I believe it was related to both. As you pointed out, the 8.5% probably wasn't achievable. This next slide, 19, is, I provided it to you mostly because I like it, but actually it really shows our population. So the blue and the yellow blob kind of on the right, those are all the members that we have that were hired before 2006. And this is basically number of members on the left-hand axis, and then years of service on the right. So the blue members there, which is a big group of people, their benefits already been set. So anything I change in the plan that might impact their benefit isn't going to change that. The yellow members, they're in active service, but they have the more generous benefits than the newer people. So they're still active. They're not eligible to retire yet, and they're working through the system. The red group, that's the new group with the new tier, and that's the tier that's going to turn the ship. Unfortunately, that group isn't going to turn the ship fast enough to meet our needs. So this is kind of the stuff that we're looking at, is what do I do with these groups of people in our plan design changes, and what makes a change. So that's just for information, I guess. So I've talked a little bit about this. I won't go over again, but we've done a lot on the investment side. I think I didn't mention all of these real estate assets a lot of them were with one manager, and we've now transitioned those to several different institutional quality managers. They've taken a look at them. They've reported back to say, okay, this is what you have. This is what it's possibly worth. Here's the steps to maximize the value. So we've got several different people working on pools of assets, which I think has been very good. We've terminated our long-term real estate consultant, and NEPC is going to pick up the real estate portion of the portfolio, which they didn't have before. We have, I mentioned the investment reporting, asset allocation change, and the new policy. So I won't go over those.
On the real estate portfolio, do you have investments that were managed prior to the realization that portfolio was not where it should have been? Do you have managers or decision makers that are still in place that were associated with those decisions?
We have, correct me if this isn't right, we have, the bulk of the assets were with one manager. Everything's been taken away from that one manager, except for we're in a multi-housing fund that we can't get out of. So there's that one piece. There are some partners, but not really the investment managers, that kind of existed before that might be operating certain assets, but we have separate managers over all of those. So the top level is all changed, basically. There are a few operators still in place, is that?
For the most part, there's one or two managers who manage one or two pieces of real estate that were there, but they've not been identified as being, I mean, they're top quality managers. There's no issues or problems with those managers whatsoever. So.
Or that real estate.
Or the real estate. It's all operating real estate that is just getting ready to, is either throwing off cash flow or getting ready to be sold.
It's more typical, not.
Is the plan considering, or have you taken any legal action related to your real estate portfolio? Are you facing any legal proceedings related to that?
The board has hired the firm Diamond McCarthy to look at all the transactions going back to 2004. They've been working on this since about August, and they've gone through a significant portion, reported to the board multiple times. They're still working through that. We have, do you want to talk about, I don't want
Well, so there's I mean, we can talk about the public filings. The asset manager that Kelly was referring to, CDK Realty Advisors, was a public filing. So those speak for themselves. Obviously, can't speak past what's there. I can also tell you that the board made a motion publicly to authorize Kelly to engage Diamond McCarthy to bring any other, to pursue any other potential claims that would bring more assets into the system. Past that, obviously, I can't speak to that. So this process is ongoing, I think, is the best we can say right now.
Thank you.
Mr. Chairman, is the FBI conducting an investigation of your offices?
The FBI is conducting an investigation of transactions related to DPFP. I wouldn't say an investigation of our offices.
So they're focused on CDK?
I can't comment on their focus.
Do we have any idea in terms of timeline of resolution of that issue?
Of the FBI issue? Oh, no, they don't share their plans.
Of course they don't. All right, thank you.
Okay. So I've mentioned this, we have a new asset allocation. We focus on liquidity and generating cash flow, and maximizing our returns at an appropriate risk level. And I've said also it's going to take some time to get there. On 23 is a detail really of the asset allocation, and what you have here are the categories, our target, and then if we don't do anything like a secondary sale to move assets quicker, how long would it take to get there? And if you look at the kind of the equity category, it seems like we're okay because it says our target's 30% on the top line, and we're pretty much close to 30%. But if you drill down into those sub-pieces, you can see that it really does take a lot longer to get there because we have a significant portion in the private equity. We want to lower that and put more in the public equity. So there's a lot of movement that needs to go on here. And it's also challenging when you have net outflows in your plan. That's taking off more of your liquidity, frankly, every month, that then it inherently makes your plan more illiquid. So we've increased the fixed income portion of the portfolio to invest in things that generate cash flow. So that's kind of where we're headed.
So I remain concerned looking at this, that so much of the plan's portfolio, given the plan's history, this particular plan's history, is tied up in assets that are very difficult to value and may have lots of variability in the valuation of those based on local economic condition where those investments are made. That's concerning to me. That can play through to plan assets pretty heavily, and in my opinion, it's very difficult for any of you, and especially members and city council, to actually understand the risk that they're taking on in that portfolio. So I would encourage you over time to take additional looks at your target allocation, specifically your target allocation to real estate and private equity, the types of things that are very difficult to value, place an annual value on, and that are very dependent on local or sectoral economic conditions where those investments are.
I understand that completely, and the idea of this 12% real estate target is not the real estate we have today. This we would like to get out of at a reasonable cost, the best price we can, of our current opportunistic real estate, and invest in real estate such as apartment buildings and office buildings and those kinds of things that pay rent and that are funds, that are public information, that are much easier to value. So that would be the idea of the more typical real estate. And then the private equity piece, we'd like that to be 5%. It's just going to take some time to get there. So totally agree with.
Can you say a few words about investment fees that have been paid by the plan in the past, and perhaps anything that you have done to address any issues that exist?
So as far as fees go, one of the reasons that we chose the chief investment officer that we did is he does focus on fees. And we can kind of see that when we're negotiating. We haven't done a lot of new investments, but as we do new investments, it's definitely something that we look at. I don't know if you can say any more about what we do on fees.
I'm not sure that there's much more to comment on that.
Do you know what the fees, investment fees as a percent of assets have been over the last 5-year period?
I don't have that off the top of my head as a percentage.
Do you know the ballpark of what it's been on an annual basis over the last 5-year period?
It's about, last year, I think the total fees were about $30 million and a $3 billion portfolio, so about 1%.
Are you confident in the fee measure specifically with the real estate and private equity portfolios?
As far as private equity goes, we do have outside legal counsel that specializes in private equity that looks at all of the private equity investments. And, you know, we talk to them a lot about, is this typical fees? Are we, you know, what are we doing here? Those kinds of things. So I think that's helpful. The real estate fees, again, they're difficult assets to manage. So we've worked with our real estate consultant. When we brought in these new institutional quality fees, we did a kind of a, not an RFP, but an RFQ kind of thing. Our real estate consultant did that. We had people bid on it. They proposed fees. The board selected them based in part on fees, but also their quality. So we had them consulting us as well.
I think it's also fair to say that there's a lot of variability between pension systems and how they account for fees, as dealing, especially not so much with the stock and bond portfolios because those are more straightforward, but dealing with private asset, private equity type of fees, what's paid, what's not paid, how it's accounted for, that type of thing. I don't think it's always an apples to apples comparison when you look at the fee numbers in CAFRs from public pension system to public pension system.
I think that's right, and what you just highlighted makes it very difficult for anybody on the outside to adequately understand exactly what is being paid, specifically on real estate and private equity in terms of fees. This has been an issue that has, of course, gained attention nationally. We've had some of the largest pension plans in the country come out and essentially say, we don't know exactly what we're paying on our private equity portfolios in particular. I would be very interested to better understand kind of fee levels over the last 10 years and then understand what we expect those to be going forward. And it would be great if there were particular information around these difficult to value and manage portfolios and if it included kind of total all-in fees for those investments where possible.
I agree with that 100%. I'm sorry.
With regards to your fee structure and some of the plans I've seen in other parts of the country, with regards to PE and real estate, do you have clawback provisions in the compensation of the fees as regards to returns?
Generally, there are clawback provisions in these private equity agreements where if the manager does not reach the ultimate hurdle rate, then the fees are clawed back at the end of the term of the fund. Yes.
And so have you been able to claw back any fees that over the years, given the returns that you guys have had so far?
I'm not sure that there has been a situation, although I can't swear to this, I'm not sure there's been a situation where a clawback has been necessary such that we had to effectuate it. I don't know that the issue on our returns has been more in the real estate portfolio than in the private equity portfolio.
Comment here. As I look at this, I'm seeing that the large position in real estate, private equity, was an important part of your total problem. Would you agree with that?
Yes, sir.
And
Mr. May, can I specify here, it looks like the returns in bullet on page 11, returns on the real estate portfolio were negative 32%-ish. Returns on the private equity portfolio were negative 20 percentage points. So I think that you're right to highlight that these are, the combination of the two was the biggest problem. I think private equity on this sheet of paper, as far as I can tell, looks like a pretty significant problem for the plan. So go ahead, Mr. May.
Well, and this is one to think about for the future, not just your plan, but all of the plans in Texas that we have responsibility towards. If we had to do this over, would there have been a better result if there had been a slower move to a very aggressive investment approach? If the state or a state agency had a role in it too, would we have had a better result? I'm worried that it puts a lot on. Well, in your case, it was one individual, and that the process needs some broader input. And I know you've tried real hard, and you've got a lot more input now, but is there a role for the state in some way? I'm not arguing that there is or isn't. I'm putting a question out for future thought.
It is a useful thing to think about that it seems that the regulatory environment was very loose on a few of these key decisions around investment choices, but also funding policy and some other elements, plan changes that increase benefits without an adequate plan to pay for those benefit increases. So I think that Mr. May's question is directly relevant to say, should there be some guardrails set around kind of important decisions in terms of plans, investments, and benefit design?
And where that question gets hard is that who is the fiduciary? Who has a fiduciary responsibility? And even if I were to say, well, I think we would be better if our agency gave more input onto these issues, we're not the fiduciaries now. And so this would be a very difficult legal question. We'd want to work with legal counsel on to just know how far we could go, even if we thought it was a correct way to go.
Yeah,
Tough issues.
I think that our new implementation of our new investment advisory committee will help along those lines, because there'll be 4 outside professionals that live in Dallas that are willing to help, that will be a part of that process. And I think with that expertise, we should not repeat this.
To quickly add to the agency's role, Mr. May, the Pension Review Board can most certainly put out prudent investment practices for our retirement systems. That is part of our mandate, so that's something the agency can consider to do.
So that might be an interesting thing for us to consider as a board, putting out kind of best practice statements around some of these important decision-making elements for public plans. I think that could serve as a potential check. Of course, there wouldn't be any actual kind of authority that goes along with that. It would just be statements of best practices.
I would go so far as to say that a statement of best practices out of this agency would have made no difference in this case. Your predecessor did not have an interest in best practices. It was not a lack of information that led to the problem here. And really, I think we need to be looking at a system of checks and balances that need to be in place.
Sorry, Mr. Brainard, do you think that governance reforms are what would fix this, and the governance reforms, that the steps that they've taken to reform the governance of the plan are appropriate and are likely to move the plan in a positive direction?
Well, I would say that what they have presented here is very encouraging, and y'all are cleaning up a royal mess. And I appreciate the work that you all have done. What governance reforms need to be made, I don't know. I don't know what governance reforms have been made in Dallas. You've made plan design changes, you've made structural changes with regard to the oversight of the fund. What governance changes you made, though, I'm not sure, and I'm not prepared to comment on those.
I can.
One long-term observation. I'm glad that you are a large city in a large state with good overall growth potential long-term, and that's going to help you compared to where you'd be if you didn't have that going for you.
Have you looked at or presented information that compares current contribution levels to Dallas's general fund revenue or the resources of the city's ability to make good on the calls on their resources, and then have you projected those in the future?
I have not looked into the city's budget to try to determine what I think that they could afford to do. But what we are doing, and it's a slide, I'll just cover it now, is we have a long-term financial stability subcommittee that's looking at all kinds of plan design changes, everything related to the plan. But in addition to that, there are also, they're looking at governance issues as well. But in that committee, Sam appointed 6 members to the subcommittee, 2 police, 2 fire, 2 council members. But we've invited the city to participate as well. So they're not voting members on the committee, it's just an advisory committee anyway. But at this point, the city people have been participating. The chief financial officer has comes to the meetings, the HR director, the controller, people from their legal department. The city auditor has come at one point, city manager came at one point, and then recently one of our trustees resigned from the board, and now he's the city's lead on that delegation. So we are working very hand in hand with the city, and we're going to make all the plan design changes that we can make that are in our control, and then hopefully the city can fill the gap if there's a remaining gap.
So this is an area of great concern to me, that workers come to the table and give a lot on the benefit side without a more full commitment from the city to actually make sure that those benefit promises are kept. So I would encourage you very strongly to continue working with the city, but additionally to try to get them to make a more full funding commitment that is not fixed rate, that floats with the economic conditions of the plan, that actually funds the benefit promises that they are making to Dallas's workers.
We'd like that. Okay. On 24, it's just one more slide on the asset allocation, and I don't really need to go over it other than to say the light bars are our current allocation. The darker bars behind them are the new targets, and you can see, as we've discussed, we've got a lot more real estate than our target. It's going to take some time to get there. The goal is to move to more liquid strategies, so I'll move on from that. We've talked about the Investment Advisory Committee on 25. I talked a little bit about written recommendations are required from our consultant, which that is a change. That's a change. So
Where's the change?
well, before they didn't have to, first of all, there was no requirement that the consultant weigh in on investments. There was definitely no requirement that they put it in writing. And when you don't require something in writing, sometimes people sit on the fence. But they have to have a written report on we agree, we disagree. The board can still do it if they disagree, but I think they would think, long and hard before they did that. But, adding this rebalancing piece, because our rebalancing is so critical, to have them weigh into rebalancing is a good thing as well. And we're firming up our due diligence processes as well. We're in the process of doing that. Other things non-investment related that we've done is we hired a new chief financial officer 2 years ago, and she's really the person that started looking at the financial statements. She comes from a Big 6 or Big 4 firm, whatever it is now, and understood that they needed to be reported at fair value, which they weren't before, and that's kind of how a lot of this started happening to come to light. So she's been a great addition to the team. We've implemented a new real estate asset valuation methodology, which is in alignment with accepted practices. We've revised our accounting internal control policies and procedures, improved financial reporting to the board. We have a new audit firm I mentioned before. We revised our annual report to comply with the GFOA standards, received the award for the first time, and we terminated our long-term actuary.
One thing that's not on that list, which is the most important thing that we've done, was hire Kelly. She didn't put herself on there, but that was the best thing we've done.
Thank you. Appreciate that. We completed a experience study, which I mentioned. Last year, we did the rate of return adjustment. That went into the 2015 valuation, and the 2016 valuation will be all the other changes that the board adopted last month. Where Sam implemented a process, which I think is great, where on an annual basis, the board is going to have a conversation formally with all of the service providers. So it's going to be kind of a closed meeting, no staff, where a subset of the board can meet with our investment consultant, our outside legal counsel, the actuary, similar to what you would do with an audit committee, and say, what do we need to know? Is staff giving us all your advice? Are you being blocked? Are we doing anything that's unusual in your area? Do you see anything? Do we look weird in any other areas you see? And they can really have a good conversation and hold these people accountable that they understand they report to the board, and they give them an opportunity to provide feedback in a way that isn't sheltered by anything that staff is going to do. So I think that's a huge change that Sam has made. We talked about the investigations. We're communicating things like this that people don't want to hear to people that have not been heard of before. Our members, the city, the press. We're telling it like it is because that's the path to get it solved. Plan amendment litigation we talked about. We have a governance committee that's working on all of our policies and procedures, roles and responsibilities, committee structure, those kinds of things. And then lastly on that page, I talked about the long-term stability committee. And I think that's the end, and I'm happy to answer any additional questions.
Thank you very much, Ms. Gottschalk, for coming and presenting. You guys are to be commended for, I'm guessing, doing a number of these types of presentations, and these are never easy with people asking very difficult questions. I'm sure it's even more difficult when talking to local plan members and trying to bring them up to speed on the health of the plan. So you're to be commended for taking those difficult steps and considering all options.
I agree with that. That you really appreciate how your hard work trying to move this along.
Thank you.
It's a big step towards openness that we didn't see before with this plan. Other board comments, questions? Seeing none,
If I could just add one thing I should have mentioned, the staff of the PRB has been very helpful to us throughout this process, so I just wanted to thank them for that. Thank you.
Thank you, Ms. Gottschalk. Thank you. Mr. May, report from the work of the update on the work of the actuarial committee.
Okay, where are we? Yeah, and where is that spelled out? Okay, and then we go from that to Ashley. Okay, the actuarial committee, I'll start this. We'll have a number of people giving input on this point. The thing I'll mention to start is just returned from a meeting of enrolled actuaries. These are actuaries enrolled at the federal level, but they're public sector, private sector. They're public sector actuaries like me, and all I would note there is a couple of things that we were grappling with. It has to do. Let's see, I've lost my point here. Let me move this to Ashley, and I'll come back to this for me. Is she here?
Thank you, Ashley.
Thanks.
Good morning, members. My name is Ashley Rendon, and I am a policy analyst at the PRB. And if you would turn to tab 4A, we have the Public Retirement System Compliance and Reporting Summary. And So this shows a summary of compliance along with total net assets as well as amortization periods, and we do a kind of comparison from the last board meeting, what we reported, and this current board meeting. So what I want to bring a little bit more attention to is the summary of plans non-compliant over 60 days. At the last board meeting, we had 8 plans on that list, and at this board meeting, we have 5 as of last week. We actually received 2 more of those plans on the list, which are on the next page. We received 2 more of their annual financial reports. And so Corpus Christi Regional Transportation Authority, as well as Texas City Firemen's Relief and Retirement Fund, are not on the list today. And so these plans are the plans that we post on our website per state law, as well as per our non-compliance policy. And after they have been non-compliant for 60 days, we send their sponsor a letter notifying them of the plan's non-compliance, as well as the fact that they're going to be posted on our website. And then once we do receive their missing reports, we send the sponsor another letter letting them know that the plan is now compliant. At our last board meeting, we did talk about 2 plans, Corpus Christi Regional Transportation Authority, as well as Northeast Medical Center Hospital Retirement Plan. And since that meeting, we did receive Corpus Christi's RTA's audit, and we've also kind of ramped up our attempt to communicate with these plans. With both of those plans, we had trouble communicating with the administrators. And so for Northeast Medical Center Hospital Retirement Plan, we were able to receive a letter from their board chair stating that they will perform an audit for 2015. And so they're listed twice. Their due date is at the end of January, and so we are missing 2014 and 2015 reports for them. The next few pages are examples of the letters that we send to plans for non-compliance, as well as compliance for the 60-day non-compliant date. And then we have a list of the total net assets for each plan as of the most recent received report. And so that concludes my presentation. If you have any questions, I'll be happy to answer.
I'll come in here with one of the things I looked for at the enrolled actuaries meeting was anything that was unusual, different, and one thing that we plan to work on moving ahead at an actuarial committee meeting or two is should we develop a new method. I think, Josh, you brought this up, but whether we ought to, these are my numbers or letters, but instead of amortizing, paying normal cost, amortizing an unfunded liability over 30 years, should we say that is a C or a B or an A, and go to a sort of an additional letter approach? And there's certainly some merit in this. I would note that I tried to dig around at the meeting, and no one is really doing that now. So that doesn't mean we shouldn't do it, but it's not being done now. But we'll be picking up on that whole question at a meeting of the actuarial committee, and everybody here's invited, encouraged to be at the actuarial committee of the board, because it would be that committee that would then bring something back to the whole board. I guess we're down to C now. That's all I have there.
Members, did you have any questions on Ashley's non-compliance report?
The non-compliance report, so based on the information that you gave, there are 5 currently listed here. 2 provided information between the provision of this packet and the meeting. So we have 3 current non-compliant systems.
Yes.
What are those systems? Could we just list those real quickly?
So that is Irving Supplemental Benefit Plan, Brownwood Fireman's Relief and Retirement Fund, as well as Northeast Medical Center Hospital Retirement Plan.
Have we had contact with the other 2? It sounds like you have had, of course, contact with Northeast Medical Center. How about the other 2?
So Brownwood Fireman's Relief and Retirement Fund, we have, they did let us know that they would be performing an audit in 2015, which would be due at the end of July this year. And since they didn't send in an audit for 2014, they're still on the list. They've been on the list for a while. But we do know that they will be doing an audit for 2015. Irving Supplemental Benefit Plan, they actually, we have been in contact with them. They have a new CFO, and he has informed us that they'll be doing a combined 2014-2015 audit to catch up.
When will be the next notification of these plans that they are out of compliance?
We do a 15-day non-compliant email enforcement past the due date, and then we do another one at 45 days, and then after that they get the 60-day notification. After those kind of official notifications, we try to reach out with the plan. I think with these plans we kind of try to do it monthly.
Okay, so you guys have monthly outreach to these plans that are on the non-compliant list that have due dates that are well in the past. I mean, some of these, so you rightly noted that Brownwood and Irving have been on here for quite some time and have due dates that are either over a year past or close to a year past.
Yes.
And members, just to quickly refresh, one of the reasons why Brownwood Fire has been on this list for a long time is in 2013, the legislature clarified the annual audit requirement for our systems to where the systems are now required to do a standalone audit instead of piggybacking on their sponsors' audits. Brownwood Fire, for example, was not doing a standalone audit, and that's something they're now considering to do and are now in the process of RFPing and looking for an auditor.
And that is actually the case for the other plans that are on the list as well. They used to send us, the audit that they sent us before, and we do have what they sent us last year, are audits of the sponsor with the plan included. And so what they were kind of tasked with is now doing a separate plan audit.
Right. Thank you.
Mm-hmm.
Yeah, I just have a quick clarification question. You have 6 non-compliant over 60 days, but then if you go to page 1, there are 5 of them. Is there any?
Right. Northeast Medical Center Hospital Retirement Plan was listed twice on that list for 2014 as well as 2015.
All right, thank you.
Mm-hmm.
Did you list it twice because for emphasis or just that?
I'm not sure.
Thank you. Any other questions about the non-compliant list? If not, thank you very much. Oh.
Actually, anything else you need to say to us? If not, we'll just go to the next person.
Sure. No.
Okay, and next within the actuarial section of this agenda, tab 4B, actuarial evaluation and report, Kenny Herbold. Kenny, could you come up and take the lead on this? Kenny's our new staff actuary, and he's the one who put this together.
Good morning, members. My name is Kenny Herbold. I'm the staff actuary for PRB. You all have behind tab 4B the current actuarial evaluation report. I'm assuming that everyone is relatively familiar with the format, so I'd like to just draw your attention to the table in the middle of page 3, which kind of summarizes or aggregates the data that's available. The first item is a list of the amortization periods. We've grouped them into different groups based on best practices, what we agree is inappropriate or a little bit too long. So anything above 40 years is something that is considered to be at an issue. I just would like to point out that on average, the amortization periods are decreasing. If you'll notice that the number of periods that are, or the number of plans that are at infinite moved from 12 down to 4. The number of plans that kind of fall into what we've considered or what the PRB has designed to be a good range of 15 to 25 years has increased from 16 to 23, and then the number of plans that are at a zero amortization period or are fully funded have moved from 2 to 4. Now, if you will notice, though, if you look at the aggregate of assets and unfunded accrued liabilities and the funded ratios, the funded ratio did decrease by 30 basis points from one to the other. Now, even though the average amortization period has decreased. The largest reason for that is the size of the plans that contribute. There are essentially 3 plans that, well, actually, let me take a quick step back and say that the unfunded did increase by about $3.75 billion. The primary reason can be attributed to 3 different plans. One of those is TRS, which makes up more than 55% of the total liability. So anything that happens to that particular plan is going to have a significant effect on any aggregate numbers that we're looking at. The other 2 plans are Dallas Police and Fire, which you've clearly heard a number of their concerns and issues, and then the Employee Retirement System of Texas, which is also one of the largest plans that impacts us. So one of the reasons that TRS, or the primary reason that TRS did increase so much, their unfunded accrued liability was about 35% of that total $3.75 billion, so it was $1.33 billion. They had significant asset losses in 2015. They made a number of assumption changes from 2014 to 2015, which contributed to the increase in the unfunded. And they all, in the 2013 legislature, their contributions were increased, but those are deferred, kind of stair-stepped up, and so they're not fully recognizing all of the contributions. It is recognized in their amortization period, but since those contributions aren't going into the plan just yet, their unfunded is going to continue to increase. And in general, for ERS, it was significant asset losses in 2015. And I do want to make a note that all 3 plans have commented in their actuarial evaluation reports that they expect this trend to continue in the near term. For TRS and ERS, they are, because of the 2015 losses, they're currently smoothing their assets and they have deferred losses, so they expect that as those losses kind of move into their actuarial value of assets, their unfunded accrued and their funded ratio will decrease in the near term. So if anybody has any questions about that, I'd be happy to answer them.
So I'll note to the board that it is positive movement on this amortization measure that we have here. But if you refer to, if you flip past the green page and look at AVA, so actuarial value of assets, or smoothed assets, I should probably just say smoothed assets. Not really actuarial in any way, shape, or form. Just smoothed assets versus market value. You'll note that you see a lot of deferred losses comparing those 2 numbers. So in a lot of cases, the market value is below the actuarial value. Last few years have been pretty good in the market. Last year and this year have not. We're going to see some deterioration of those numbers that looks probably will be larger than the improvement that we've seen. So we should just be prepared for that there's some deferred losses and certainly losses coming through this fiscal year that will hit. When will we see those? We'll see those in our fall meeting.
It depends on the timing of when we receive the actuarial reports, but they are incorporated into this report as we receive them.
Let's see, for teachers and state employees, they get their report through the end of a fiscal year that's August 31.
Right.
And they typically have to work hard and fast to get ready for a late November or December updating of the actual position of the fund.
Another concern that I have about our amortization calculation, and we've talked about this is the use of open amortization and plan-sponsored plans being given credit for 30-year amortization, whenever in reality they will simply reset their amortization schedule the next year. So in reality, it is not 30-year amortization. 30 years down the road, that unfunded liability will not have been paid off by the sponsoring government. In fact, many of those plans, especially given the increase factor in their payment schedule, employ infinite amortization schedules, but because they list them as 30-year open, they engage in a fiction that puts them here on our sheet as having a 30-year amortization period. This is a concern of mine. This is a concern because I don't think that type of funding plan meets the obligations to employees that those cities are making, and I think that we should really consider that going forward. Find a way to update the amortization period here to reflect actual plan amortization. So for plans that employ, let's say, a 30-year open, a rolling amortization schedule with a 3 or 4% increase factor, that's an infinite amortization schedule. They will never pay that off, and we should find a way to consistently be able to reflect accurate information on actual amortization schedules here.
I got a quick question. On page 3,
Yes?
the last plan, which is Refugio, has a 0 amortization, which looks good, but it's frozen. What is there a conflict there? Or?
I'm sorry, is it a conflict that they have a 0 amortization? It just
Oh, no,
means
I mean, it's frozen. What does that mean?
It means they're not accruing any additional benefits, and there are no additional employees, there are no new participants.
No new participants, okay.
So it's basically the accrued benefits in the plan are the accrued benefits, and that's it.
Thank you.
Are there any other questions?
I'm sorry. I have just one education question. At what point do you move from the greater more than 40-year amortization period to infinite? Because I see that Wichita Falls has 105-year, and so what's the kind of tipping point?
It's essentially when the payments are not sufficient to pay the interest on the unfunded accrued liability.
Okay.
So you calculate the normal cost of the plan is essentially the current benefits that are accruing in the given year. You apply the expected contribution to that first, then you apply any remaining contribution towards the interest on the unfunded, and if it's not sufficient to pay that, then it would be considered infinite. Otherwise, there's a finite time that you would expect to be able to pay.
One question I had in relation to Dallas, who we just heard from, I would be interested to know, to kind of square the circle on their amortization period, given that we just saw that they've got a cap of 28%, and currently their contribution rate is 27.5%, but their required contribution for 30-year amortization this year is 42%, would go up to 65, 66% probably in this fiscal year. So help us understand how we've got them listed as a 50-year amortization here when it sure sounds like they probably are infinite. Is this just a delay in updating our numbers?
Where are you seeing?
Oh, I'm looking at the wrong one. So we've got them at the top in infinite. Sorry.
Yeah, they're the very top one. They went from 26 to infinite.
Gotcha. So how often do we update these numbers?
So these are based on what's reported in the actuarial evaluation. So it is dependent upon how frequently an evaluation is completed. So most of the large plans complete an annual evaluation, and then we will update our report as we receive them. And so, for Dallas Police and Fire, when they do the 1/1/2016 actuarial evaluation, 2015 will move over to the prior column, and we will include
There's
those.
quite a variance between some develop and turn in actuarial evaluations quickly after the end of their fiscal year, and others take a much longer time.
Yes, and there is.
We've always accepted whatever we got and adjusted it. We may want to rethink that at some point and push harder, but we've tried to. They're looking to outside actuaries, and they have cost issues to keep up with. Just the actuarial fees within their budget. And so they're all over the place in terms of the distance between the evaluation date and when we actually do the work.
Right, and I believe the legal requirement is to provide an actual evaluation at least once every 3 years.
Every 3 years?
Yeah.
All right, thank you. Any other questions?
Well, just a follow-up comment, Josh, on something you mentioned. We've got, we at the current time, we have we solve for the amortization period given the contribution rates from the members and the employer that come into the plan. And so if we think of teacher retirement and Texas state employee retirement, I believe they're both at a, is it 32 years?
33, yep.
33. And so if we followed your approach, they would go to infinity, I believe. And so there'll be time for discussion and debate on that. But one thing about it that would switch consistently is that actuarial that amortization period, 32, 33 years, has a major role within the state agencies, and so that would be a big shock change. And both systems have retirees who have been told, looking at the state agencies, that they have this amortization period of 32 years. If they had gotten it under 30 years, then there would be a strong desire for a COLA to retired teachers, retired state employees. So it'll require some real thought on our part about how we want to change it, because it'll have a major impact on the way they operate, those two systems.
Yeah, I appreciate those considerations, Mr. May. My difficulty is in actuality, the contribution rates into those plans, the expected contribution rates over the next 33 years will not meet that 30-year ramp. In fact, they will be substantially lower. And so we are not being fully honest with plan members or the state legislature when we say that the amortization period in actuality is 33 years. It is actually much longer. Our expectation for that amortization period, based on what payments into those plans will actually be, is much longer than the period that is listed here.
Well, I may want to debate with you, but not today. We've got the actual committee meeting, and we'll push that over for some more discussion at a later date. What's next under the...
I did have one more point I wanted to make about this particular report. If you'll notice, there are 92 plans in the count at the moment. Last board meeting, there were 93. There are technically 93 plans listed here. The very last one we added is Woodland Firefighters. They have not. It's a new plan. They have not reported any information yet, but we wanted to go ahead and include them on here, so it's, it's forthcoming. And there was a plan that we removed called Cypress Fairbanks, which I'll use as my segue into the next report to talk about the Cypress Fairbanks ISD.
So Kenny, do you know if Woodlands Firefighters is using an open or closed amortization?
We have not, nothing has been reported yet, so we don't know.
I am comforted to know that we still have 93 plans that we're paying attention to. Something would be wrong with the world if we didn't have exactly 93 plans, so thank you for that.
So if I can direct your attention to tab 4C, we have a somewhat more detailed summary than I'm going to provide on the Cypress Fairbanks ISD plan. During the last board meeting, the staff informed the board that Cypress Fairbanks had recently terminated their plan effective December 31, 2015, and the board had asked for additional information on the impact of that plan termination on the members of the plan. So in general, the Cypress Fairbanks terminated or froze their pension plan effective December 31, 2014, and replaced it with a non-elective defined contribution plan. Cypress Fairbanks ISD is, their employees do not pay Social Security, so they are required to have some sort of FICA replacement, and that's what they're participating in. During 2015, they they terminated the plan effective December 31, 2015. They have committed to fully funding their plan and paying out 100% of the accrued benefits, and they made those contributions and funded the plan up to approximately $10 million during 2015 and 2016. They have, in 2016, they sent all of the distribution paperwork to their members, and they expect to fully distribute all of the plan assets by June of 2016. So if there are any questions?
Well, thank you. I was the one who raised it, and I appreciate you all looking into it and following up.
Not a problem.
Thank you very much.
Am I correct in, so you said this is a FICA replacement plan, so it looks here, you had questions, I believe, Mr. Bernard, about the contribution rates into that plan. It looks like they've set the employee contribution rates at the IRS safe harbor provisions for this type of plan?
That's correct.
Okay.
Thank you.
Calling next on Anu, actuarial section of the report.
Members, behind tab 5A, we have included an update report on the Funding Soundness Restoration Plan lists of systems. Since the last board meeting, the first list, which contains the systems which are immediately subject to the FSRP formulation requirement, has changed. We've added another system to this list, which has moved from the second list based on their most recent actuarial valuation. And the second list, which are the at-risk systems we are monitoring that could have a triggered FSRP requirement in the future, now have 4 systems on it. And we wanted to provide this updated list to the members.
You said you added one.
Yeah, what were the 2 changes?
We added Sweetwater Fire moved from the second list, at-risk list, to the immediately subject to list.
And on the at-risk list?
There wasn't any other change on the at-risk list.
So we just reduced by 1.
That's correct.
That completes the actuarial section.
Yes. We do have some additional items. Members, behind tab 5B of your packet, we have included, or let me step back. At the last board meeting, we had proposed some updates to the board's determination of system actuarial review policy. And at the February board meeting, the members had directed staff to survey the systems to solicit comments from plans. And we conducted the survey in March and received comments from one system. We worked with the system as well as with our Attorney General Counsel to incorporate some of their recommended changes to the policy. And we have included a chart, a recommendations chart in your packet behind the green divider, which details the changes we've made to the proposed updates since the February board meeting. We have made some clarification related changes, as well as based on the comments we had received from this one system, we did add some formal notification and response periods for the systems, as well as we tried to clarify some terms, add some definitions to the policy to make it formal and clearer for our systems. And those changes are detailed in the recommendations chart for you. Additionally, members, since we sent the packet out in consultation with our AG counsel, we did notice a discrepancy in our revised proposed updates. Hence, in your meeting packet, at the back of your meeting packet, we have included a revised proposed updates, and we have redlined those changes for you to look at. We have updated the term that we were using in the policy from over 40-year valuation determination to over 40-year amortization determination. In consultation with our AG counsel, we thought appropriate to make that change since it was reflective of the process we are recommending in this policy. In addition to that, we made some changes to number 1 and number 2 to define the term clearly in the policy. And we have included those changes for the members to look at as well. And at this time, staff is requesting the board to adopt the policy with the proposed changes if the board feels comfortable. And just to quickly note that down the line, we would be coming back to the board to adopt this policy in its administrative rules. Members, do you have any questions?
I'm sorry, did you say you want us to adopt it in this meeting?
The policy presented as is with the proposed changes, yes, but down the line we will come back for the boards to adopt this policy in their rules.
I'm wondering if we had time to read it. Okay.
If the members would like...
You're saying, you're suggesting that it's 2 steps.
Right. So for now, at this board meeting, we are requesting the board to adopt or approve the policy as presented, and down the line in the future, we will come back with the rulemaking notice.
So there's a difference between the policy of the pension review board and the actual rules. And so at this point, they're asking for approval of this as policy.
Correct.
And they will come back to us if when they want to put it into the actual rules for the PRB.
That's good.
I'd move approval of the rules as proposed and amended.
I second.
Policy.
Not rules.
Sorry. Policy as proposed and amended.
So the motion to approve the updated policy for determination of system actuarial review as amended and provided in the back of our packet, pending final approval by the Assistant General Counsel. Is that the motion?
Yes, sir.
I have one question.
That's
You have a
okay.
question?
Well, I thought you were going to allow discussion before I
I
vote.
will, yes.
So I just had one question about the policy number 9, the addition of the provision to provide the entities with 20 days written notice, or 20 business days written notice prior to the meeting. Can you kind of walk us through the logic behind that? I mean, 20 business days seems like a fairly significant amount of notice time. And just with our board meetings, depending on when the determinations are made, that may cause some type of significant delay with this coming before the board.
Thank you for that question. We are proposing this change based on a comment received from a system, and we believed that given the process in step 9 would be very formal, to where the board would review the staff report and would also request the system to come before the board with regards to their amortization period determination. And given the fact that we do try to schedule our board meetings ahead of time, we thought appropriate to allow the 20 business days notice period to the systems.
20 business days being
Essentially
about a
30
month. Yeah, 30
days.
total days. It is a little bit out of alignment with some of the other lengths of notification or waiting period, other places in the document. It looks like we've had, we had one system comment on this, and that one system questioned the waiting period, both the shorter waiting period for a response around the over 40-year amortization determination, as well as this one.
That's correct. And for the over 40-year amortization determination, essentially we were recommending to the board to allow a 14-day response period. However, based on a board member comment that we received, given that the systems may have to work with their actuaries to provide a response to any over 40-year amortization determination, we thought appropriate to recommend the board to allow a 30-day response period rather than a 14-day, but certainly if the board would like to change that, we can revert back to...
Yeah, I was the one that suggested we bump it up to the 30 days. Just, as you said, just there's, these systems, to by and large, are going to outside actuaries for help, and I think that can be a slower process. This is a pretty minor point, but I thought it was pushing pretty hard, and right now we only got one to even comment out of our 91 to our, so that's how I got there to that suggestion, but I can also go either way on it. I think that'd be better.
Most certainly, if the board feels that a 30-day response period or a 30-day notice requirement is too long of a period, we can change that to maybe a 14-day or whatever the board thinks
not my
appropriate.
recommendation, but if that's the board's wish. then
Well, I
that's
wasn't
good.
questioning the period. And step number 3 for the determination, I was questioning the time period towards the end in section 9. Since they've already been notified and theoretically they've already been present ahead of the committee to provide testimony to the committee about their determinations, it seems like they would be well-versed to speak on the issue, such that 20 business days may seem excessive. And I'll put forth that I don't have, a general idea of what time frame you're talking about going step to finish. But I was just trying to keep in mind the frequency of our meetings and whether or not that 20-day period would cause an issue to be delayed until a following meeting.
Anu, can you briefly walk us through how long you think, from the start of this process to potentially somebody appearing before the board, how long you think that will take?
Sure. So the process would get triggered once we receive an actuarial valuation from a system, and the staff will make a determination internally whether or not the system is over the 40-year amortization period threshold, which could take about, and Kenny, you can jump in here because we'd be leaning on you to make that initial determination, could, depending upon the agency's workload and the number of actuarial valuations we are reviewing, it could take anywhere from one.
Well, I think they're typically entered fairly quickly, and so it probably takes maybe a week or so before we should have a full review of the report. So.
And you would review those on some rolling basis as those reports came in?
That's correct.
Yes. Yeah, I don't think we have an established timeline, but they come in, they're entered into the system, and then they're reviewed as time allows.
That's correct. So from the time we receive an actuarial valuation to the staff conducting a risk assessment or review of a system that's been determined to be over the 40-year amortization threshold, to any potential disagreements between the system and the board, which could then lead to an actuarial committee and a board meeting. That's the first part of the amortization determination, and the next part is once the determination's been confirmed, an internal staff review has been completed, the staff could provide that information if that's what the board thinks necessary to the actuarial committee. And then the next step would be, based on the actuarial committee's recommendation, the board can request the system to appear before or appear at a board meeting. I would anticipate a 2 to 3 month long process for those steps to happen. And so if the board feels appropriate to reduce the 30-day notice period requirement to a maybe 14-day, 2-week period, given the point that you were making that the plan would have by that time already received ample notification and a response period, in my mind, that's something the board can certainly consider.
Anu,
But that's-
do you mean to say 20 rather than 30?
That 20, instead of a 20 business day notice period to a 14
We've got a
day.
difference here between business days and actual days. So the previous waiting period was defined in terms of days. This is in business days. We just equated that to 30 actual days.
I see.
So, do you have a recommendation regarding the step 9 waiting period?
I think my recommendation would be that it would be 10 business days.
Any discussion on that from the rest of the board members? Is that, given that the system will have been notified and have a long kind of period at which they would be prepared to come before the board, does 10 business days seem sufficient, or is there more discussion on that point?
I think her point's well taken, that by that point, people ought to be familiar with the issues. Let's move it along.
And didn't you also say sometime that at some point in the future, that this could come back to change, is that correct? So if the 10 days is not working, then we can always extend it.
That is a good
Right.
point. The board could revisit this time period if
When it's
need
put in
be when
rules.
it's put in rules.
Other discussion on the rule for determination of system actuarial review?
So may I amend my motion to...
You want me to state it?
Sure.
So the chair entertains a motion to approve the updated policy for the determination of system actuarial review after incorporating comments from the board, striking in step 9 the 20 business day notification in writing to be 10 business day notification in writing, pending final approval by the Assistant Attorney General Counsel.
Yes, so moved.
Second.
So the motion is to approve the updated policy for determination of system actuarial review after incorporating the comments from the board, striking the 20 business day requirement of notification in writing and amending it to be 10 business days in writing, pending final approval by the Assistant Attorney General Counsel. All in favor say aye.
Aye.
All opposed, nay. The ayes have it to approve the updated policy for determination of system actuarial review after incorporating the board's comments and pending final approval by the Assistant Attorney General Counsel.
Thank you, members. For the next item, members, Ashley will provide her report.
So behind tab 6, staff has provided a summary and timeline of the review process for the guidelines for actuarial soundness, or guidelines. For a small background, the guidelines were adopted by the PRB in 1984. The purpose was to lend consistency to positions advocated in the impact statements, to aid in providing technical assistance to registered plans, and to promote public disclosure. The guidelines were revisited in 1996 with the PRB holding committee meetings, but no action was taken at that time. And then from the spring of 2010 to 2011, about 16 months, the PRB again revisited and went through the process of reviewing and amending the guidelines. In the timeline, you'll see that we started with the PRB meeting where the board authorized the PRB Actuarial Committee to develop proposed changes to the PRB guidelines. And then after that, it was a series of surveys and then actuarial committee meetings to discuss the results of the surveys as well as make some proposals to change the guidelines for approximately a year or so. At the June 2011 PRB meeting, the staff presented the timeline to the board, as well as the summary of every single survey that we conducted, as well as provided the actuarial committee meeting minutes and opened up to public testimony. But no action was taken until the August 2011 PRB meeting, where we unanimously adopted the guidelines. And we have provided, I provided a summary of the changes that were adopted, as well as on the next page, page 3, are the 1984 guidelines with the adopted changes. And I'll be happy to answer any questions.
So in this meeting, we will be considering a motion to charge the actuarial committee to review the PRB guidelines for actuarial soundness. So this is following a similar procedure that the PRB has followed in the past to review these guidelines, refer it to the actuarial committee, and the actuarial committee would then make recommendations for a vote of the full board or amendment by the full board. Do we have board comments on this, questions?
What is the question other than to refer it to the actuarial committee?
That is it.
That's it. Okay. Well, may I make a motion to that effect, please?
You may. So the motion is to charge the actuarial committee to review the PRB guidelines for actuarial soundness.
So
Second.
So on the motion to charge the actuarial committee to review the PRB guidelines for actuarial soundness, all in favor say aye.
Aye.
All opposed say nay. The ayes have it to charge the actuarial committee to review the PRB guidelines for actuarial soundness. Anu?
Thank you, members. On the next agenda item, members, we are requesting a motion similar to the previous one, but behind tab 7, we have included a brief report to provide some background to the members of the past proposals that the board has considered with regards to developing a rating system. And if the members have any questions, I'll be happy to answer. If not, then the staff at this time is requesting a motion to charge the actuarial committee to research and consider proposals for developing a rating system.
So this is another item merely to refer something to the actuarial committee?
That's correct.
Exactly right. And this is for a rating system. I'm concerned that today we only put plans on the not fiscally sound list whenever they reach a point where they're really in trouble. So where they reach the point where they're like Dallas. And I think that plan members, the governments that sponsor them, should have more of a warning that they're going in a negative direction, or if they're going in a positive direction, before they trip over the not actuarially sound level.
And how much latitude would the committee have when they consider, I mean, is this limited to a rating system, or is it maybe something broader that could be some type of indicative system without being a rating system?
Say a little more about what you mean as far as an indicative system versus a rating system. My consideration is, so here we have, we had talked earlier about earlier considerations of doing essentially A through F on
Right.
fiscal health. I envision that this process will be much along the same lines.
So, I guess ratings, when I think ratings, I think, Moody's, Standard & Poor's, Fitch, rating system as it relates to creditworthiness of a system. If you look at, and it's some of the information that I provided to Anu, if you look at some of the comptroller's recent undertakings as it relates to financial information and transparency, the comptrollers come up with guidelines and different performance measures where they can recognize a system based on the information that's being provided in the format in which it is being provided in, which in my mind is something less than an actual rating system. And so I guess my question is, could the charge to the committee be something broader than only looking at A through F rating system to consider whether or not it would be prudent to do something lesser than a rating system, but would still be a mechanism to provide information to the public and provide some type of merit to a plan, but still be short of a rating system. I guess in my mind I see some issues associated with a rating system and some drawbacks that may preclude the board from getting to the actual rating system. I mean, there's a reason why there's not a rating system in place today. And so if we can't get there, is there another step that we can get to? And can we task the committee with looking at any interim steps to the extent that you can't get to a full system?
I think that's helpful. So if this is referred to the actuarial committee, of course, would have to come back to the full board to get a vote on any action that the PRB would actually take. You're raising highlighting a risk that those recommendations are not adopted by the full board, and you do not want to be in a situation where we have no fallback plan. I think that when this is referred to the actuarial committee can consider creating fallback plans in case their first best recommendation is not adopted by the full board.
Okay.
I think that works.
Other discussion on this issue? So the motion we're considering is to charge the actuarial committee to research and consider proposals for developing a rating system for pension plan fiscal health and annual funding adequacy. Somebody move that?
So moved.
Second.
On the motion to charge the actuarial committee to research and consider proposals for developing a rating system for pension plan fiscal health and annual funding adequacy, all in favor, say aye.
Aye.
All opposed, nay. And the ayes have it to charge the actuarial committee to research and consider proposals for developing a rating system for pension plan fiscal health and annual funding adequacy. And that concludes the section from the actuarial committee. Thank you to the PRB staff for updating us.
That's good. Keep in mind that when we talk about the actuarial committee, I guess there's 3 of us that are on it. The rest of the board is always welcome. So feel free to attend our meeting.
Yeah, can you also, as you are looking through the rating system, perhaps give us some examples of existing rating systems in other plan systems around?
Well, I think that's going to be hard because, as I mentioned earlier, when I got some input on this at the annual meeting of actuaries in Washington, I didn't find anybody that was doing this.
So
Can I add one point on this, just to kind of, as a point of clarification? I think if you looked across the country, that the PRB itself is anomalous. That's right. Having an entity that actually looks at all the pension plans within a state is an anomaly in and of itself. So us being on this board is an anomaly, and I think it is an anomaly that makes Texas a leader in transparency. So I wouldn't want to view this as something that precludes us from taking action, given our anomalous status and our leadership on this issue.
I mean, that's great. Yeah. I mean, if we're on the cutting edge of it, that's wonderful.
That would be the bleeding edge.
Yeah.
All right. So now we'll turn to item number 7 on our agenda, the legislative committee. Mr. Massingill.
I'd like to call on Alamaya to give us these updates, please.
Thank you, Mr. Massingill. I had provided an email to the board summarizing the discussions that had happened at the House Pensions hearing on March 30th and April 13th, and we wanted to include this item on the agenda if members had any follow-up questions. But just to quickly refresh, the House Pensions Committee had held 2 hearings on March 30th on local retirement systems, as well as on April 13th for the statewide systems. And the Pension Review Board was on the agenda for the April 13th hearing. We had provided an update to the House Pensions Committee, as well as had provided some time trend data to the committee. And the Chairman Flynn had asked the Pension Review Board to keep the committee apprised of the current financial challenges being faced by Dallas Police and Fire. I just wanted to bring this to the board's attention and see if members had any questions.
How do you anticipate keeping the committee apprised of the situation with Dallas Police and Fire? Will there be an update? Specifically, will there be an update on what we heard today?
We will, that is a good point. We will definitely make sure to provide a summary to the committee members on what we heard from the system today. Additionally, the chairman had announced at the April 13th meeting that the committee would be considering to organize additional hearings in Houston, which they've already posted a hearing notice for, and that hearing is on June 13th, I believe. And the committee is also looking to have a hearing in Dallas, and we will be, if the committee requires any information for that specific hearing, we will be providing information as well. I would also like to add, members, that House Appropriations had also organized a hearing on April 20th, I believe, to receive an update on House Bill 9 from Employees Retirement System. And our very own Mr. Brainerd had presented at that hearing as well. And Senate State Affairs also had a hearing on March 30th to receive an update on the two ERS and TRS systems. If the members don't have any questions, that concludes my presentation on item 7A.
Mr. Brainerd, do you have anything to add from your presentation?
No, sir, thank you.
Moving on, members, behind tab 8A of your meeting packet, we have included the most current list on the most current PRB's Iran list, which was published on April 19th and was distributed to the 5 statewide systems as well as the leadership offices as required by state law. And I wanted to present the list to the members as well.
How often does this list get updated?
We monitor, since we use Florida's Iran list to prepare our list. We monitor Florida's list pretty closely, and they publish theirs once every quarter. And we try to come out with our list once every 6 months.
I see. And this is posted online and distributed to members?
It is not posted online, but it is, as required by state law, distributed to the 5 statewide systems that this requirement applies to currently.
Should we consider posting it online?
If that's something the board would like to do, we can definitely make that happen.
Well, it's public by virtue of being in this board meeting packet, right?
That is correct.
So,
And
Mr. Chairman, you'd be suggesting we might give it more prominence by posting it elsewhere in a different format. Is that right?
I was considering making it easier to get to by posting it as a standalone document somewhere else, since it is required by state law.
I see.
Can we get an opinion from our counsel, Attorney General's office? Is this something we can do?
Well, as was mentioned, the document is a public document, insofar as it's been generated by this board and disseminated as required under the statute. It's something you could place on your website if that's what you're looking at, along with, you publish a number of things on your website.
What would be the benefit of
publishing it on the website. It's already disseminated to the 5 retirement systems that require notice of it. Who else would be interested in the list?
We do receive information requests on the list off and on from law firms once in a while. Other than that, you're exactly right in pointing out that it only applies to currently it only applies to the 5 statewide systems that we do distribute the list.
Is it fully distributed to the legislature?
The statute requires us to provide a copy to the leadership offices, the Speaker's office, Lieutenant Governor's office, the Governor's office.
So that's not the whole legislature, so this would be a source that if some legislator was interested in this, they might see it on our website.
That's correct. And since we post our meeting packets to our website, the list is currently available on our website, but it doesn't have a standalone section as it currently exists.
I don't see any downside from it.
I do not. It is public information, and I do not see any downside per se.
All right.
Let's do it.
Yeah, I would recommend that we just post it as a standalone document so people don't have to hunt and peck for it if they are interested in it. All right.
Mr. Chairman?
Yes.
Can we go back to the previous item? You asked if I had any observations on my testimony to the House Appropriations Committee, and there is one thing that I think is worth sharing, and that is I pointed out to the House Appropriations Committee, and they asked me to talk about this issue, and that is the constitutional limitation, state constitutional limitation in Texas of employer contributions to the ERS and the TRS that shall not exceed 10% of employee pay and must be may not go under 6% of pay. And I pointed out to the Appropriations Committee that among state constitutions in the United States, there is no other that restricts the employer's ability to actually fund their pension system aside from the state of Texas. And so that, to use your term, is anomalous and obviously impairing the state's ability to adequately fund its pension benefits. And I suggested, and my suggestions were not original with me, but I did suggest a couple of ways that the committee and the legislature could view the contribution and the 10% limitation so that the state might better fund and even adequately fund its the TRS and the ERS.
Do you have a digital copy of those recommendations?
I do.
Would you be willing to share that with the rest of the board?
Of course, I'll be happy to. I'll send them to Anu.
Thank you. I think you highlight a very important issue, and that is there are benefit promises being made in both ERS and TRS that currently do not have contribution rates that are adequate to fund those benefit promises, and the cap is keeping those benefit promises from being fully funded, essentially making promises that without significant changes will not be kept. And that's unfortunate, and I agree with you that there needs to be a modification in funding policy or the benefit promises that we're making to workers.
Well, for the record, right now, fortuitously, the combined contribution going to the ERS is roughly equal to the actuarially determined contribution. It's just that if the cost were to go up for whatever reason, then the state's ability to adequately fund that to the ERS would be impaired. And I don't recall whether the TRS is getting their full contribution, but I think they may be close.
I think they are. TRS.
But again, it is a restriction that could impair the state's ability to fund those two plans if circumstances were to change.
I would also point out that I believe in both of these systems, certainly for TRS, they use open amortization, and so their payment right now almost guarantees that the amortization portion will have to go up in future years, and so if they are not at it, they will reach it very quickly. For ERS members, there were some concessions last session, both on payments and benefits and contributions from plan members. Unfortunately, plan experience over the past year would suggest that whenever you said consequences would require contributions to go up, it seems we are very likely to see those set of circumstances realized with the next actuarial evaluation.
Yeah, that, and it's worth pointing out that state employees in Texas are contributing more than just about any other like employee group in the country. That is, those employees who participate in Social Security. So combined with the Social Security and the employee's contribution, they're contributing 15+% of their pay toward retirement right away.
And the state is capped at 10?
Correct.
Thank you.
Well, the state also makes the Social Security contribution, so the state's contributing 10 to the ERS plus Social Security.
6.2.
So in apples to apples, it would be 16 and 15 or so.
Thank you, Mr. Bernard. All right.
Members, for the next two agenda items, I'd like to call on Jamie.
Good morning, members. Jamie Kings with the PRB staff. I'm going to talk to you about an overview of the normal retirement age regulations and provide you with an update on current federal legislation. Behind tab 8B of your packets, you will find a report on the Internal Revenue Service's proposed guidance on the applicability of normal retirement age rules for governmental plans. This memo was provided to the plans, informing them of a few salient provisions and about the comment period, which ended on April 26th. The IRS had issued the final regulations regarding the definition of normal retirement age in 2007. This current version of the regulations would provide guidance on how the 2007 regulations apply to governmental plans, specifically the determination of whether the normal retirement age satisfies the requirements of Section 401A of the Internal Revenue Code. The proposed guidance would apply the reasonably representative requirement of the 2007 regulations, such that the normal retirement age under a governmental plan generally must not be earlier than the earliest age that is reasonably representative of the typical retirement age for the industry in which the covered workforce is employed. However, governmental plans that do not allow in-service distributions before age 62 do not have to satisfy these requirements. These regulations also expand upon the safe harbors included in the 2007 regulations and include safe harbor provisions developed specifically for governmental pension plans and qualified public safety employees. These safe harbors are outlined in the report. If the members don't have any questions, I'll move on to the federal legislation. I just want to start with a quick update on the Puerto Rico Assistance Act of 2015. This is the bill that contains reporting requirements for state and local pension systems. It remains in the Senate Committee on Finance. No further action has been taken on it since it was referred to the committee in December. Additionally, there are now several new bills related to Puerto Rico that are making their way through Congress. So far, none of those contain any reporting requirements or PEPTA-type provisions, but we are keeping an eye on those in case that changes. With regards to PEPTA, behind tab 8C, you will find a summary of the newest legislation that was introduced in March by Representative Nunes. It has been referred to the House Committee on Ways and Means. It is also identical to the 2013 PEPTA legislation. It contains federal reporting requirements for public pension plans and includes a penalty for noncompliance by denying a state or political subdivision of federal tax benefits relating to any bond issued by it until it complies with the specified requirements. Additionally, it also explicitly exempts the United States from liability for any shortfall in state or local governmental pension plans. If there are no questions,
So the upshot of the Puerto Rico bill and PEPTA is the PEPTA provisions were stripped from the Puerto Rico bill, and now they are in their own standalone bill.
Correct.
Handicapping this, it is unlikely that PEPTA will move quickly on its own, if at all. Correct?
Yes.
And it's being watched by lots of different sources.
So this is something that is that would increase the reporting burden on our plans, but is unlikely to actually pass, and therefore is unlikely to impact Texas.
Yes.
Thank you.
Are there any other questions from the board before we leave the legislative committee section here?
I'd just like to say thank you, Mayor.
Thank you.
And thank you to the PRB staff for the updates. So this completes the work of the legislative committee. Thank you, Mr. Massengill. Our next item, number 8, and we're getting close to the end of our agenda here. We're going to review and discuss a report from the executive director on a few matters. Anna?
Thank you, Mr. Chairman. I will make my presentation on these updates brief. Behind tab 9A of your meeting packet, we have included a bare bones outline of the agency's strategic plan, which we are gearing up to work on. This plan or report is due on June 24th, and essentially this report would kick off the next budget cycle for the agency, and we'll be, there were some changes to the structure of this report, so we will be working on it and probably will provide the final version to the board at its summer board meeting.
Great. Any questions from the board?
Moving on, members, behind tab 9B, we have included the engagement letter that we have received from the state auditor's office. As you all know, the agency is currently going through an financial processes audit. The state auditors have completed their preliminary round of interviewing staff who work on financial transactions of the agency, and we have been informed that the next step in the process would be for the state auditors to conduct on-site audits, which will probably begin sometime this month. The final report is expected to be released in August of this year, and I will make sure to keep the members posted on any new developments with this audit. But so far, it's been going smoothly.
And you will share that with members when you receive it?
That's correct.
Thank you.
Moving on, members, on agenda item 8C, I just wanted to quickly let the members know that the next TechSpurs Summer Educational Forum is slated for May 12th and 13th, and the Pension Review Board is on the agenda to present. So PRB staff will be attending the educational forum, as well as the TELFRA specialist, Joey Evans, will make himself available as well to answer any questions for our TELFRA systems.
And that meeting is in Dallas?
That meeting is in Irving.
Irving?
Moving on, members.
I might add that even further.
Hope you can go to that one.
Yeah.
You're assigned to go to that.
Members, moving on, the next TechSpurs Summer Educational Forum is in San Antonio, to be held on August 14th through 16th. And if members have any interest in attending, please let me or Shelley know so we can make appropriate arrangements, and we do have a motion for that item.
So the chair entertains a motion to approve the attendance of interested board members at the 2016 TechSpurs Summer Educational Forum.
I would like to go.
All right.
Move.
And I need a second? Second. So on the motion to approve the attendance of interested board members at the 2016 TechSpurs Summer Educational Forum, all in favor say aye. Aye. All opposed, nay. The ayes have it. The attendance of interested board members at the 2016 TechSpurs Summer Educational Forum is approved.
Thank you, Mr. Chairman and members. The last item under this agenda is the updated fiscal year 2016 operating budget. We have included behind tab 9C the current version of our budget as of March 31st, and everything as presented is based on the original budget adopted by the board, and we are within our budget. I just wanted to provide a quick update to the members.
Are there any items that you would draw our attention to?
Because of the turnover that we've experienced over the past couple of months, the remaining budget for our agency is higher than usually it would be in this point in time of the year. But other than that, we are on schedule and within our budget.
Any other board discussion of the PRB budget? Hearing none, this completes the reports from our executive director. All right, moving on to agenda item number 9, call for future agenda items. Would any of our board members like to request future agenda items for our next board meeting? Hearing none, we'll move on to agenda item number 10, the date and location of the next PRB meeting. The next meeting will be here in Austin. We haven't set a date yet, but we were looking at the last week in August or the first week in July. I believe that the PRB staff has been in contact with you, and we will set the date of that and post it very soon. Any questions about the next meeting?
Last week in July or first August?
Yeah. Did I say it backwards? Yeah. August comes after July, in case you were wondering. I don't have the authority to change when the months fall. So item number 11, invitation for public comment. Any public comment? I've got a comment card for Michael Trainer.
No comment.
No comment. Any other public comment? All right, seeing none, I thank the PRB staff for another great packet and great preparation for this meeting. Thank you for supporting us. Thank you to the board for your diligence and sitting through a meeting that's a little longer than probably anticipated. So if there's no further business, there's no objections, the chair moves to adjourn this meeting.
So.
Second.
The meeting is adjourned.
Okay.